What's up guys, it's Louis here, hope you are doing great. In this video I'm going to talk about some of the main reasons why majority people that invest in property fail. Property investing can be a great way to build generational wealth or to create extra income, but it's definitely not easy. The first major issue is that they don't understand how property works. In school we are taught that you should matriculate, go and study, buy a house, get some kids, and you retire. This is the idea that people have around property, and this is the concept that people have been following for years and years. Understanding how property works and how you can make money in property is vital to build a successful property portfolio. A part of this is knowing how leveraging works and the important role that leveraging or gearing actually plays in your property portfolio. Majority people are convinced that you should always pay off a property as quickly as possible or buy it cash. Although there's a place for this strategy in your portfolio, generally this is not the best idea, especially if you are starting out. And I know there's a lot of people that like buying cash or not using leverage, and there's nothing wrong with it, but majority of the time it's not the best way to approach investing in property. It's important to understand how property actually works, and the only way to understand property is to look at people that own massive portfolios. You can literally look at people like Donald Trump or large property investors in South Africa and follow what they are doing. Another issue is that they don't know how to run the numbers. People will literally buy a property that they see online that looks nice and that they think is a good investment without doing any market research or understanding the location that they are buying in. They simply see it as a good deal if it is in a high income neighborhood. And again, the biggest mistake that you can make is not understanding the numbers. I see a lot of people that own property and that has never even tried doing return on investment calculations. The numbers never lie, and in order for you to realize whether a deal is a good deal or not, you should be able to know the income minus all of the expenses. Does that give you a cash flow positive amount or does it give you a shortfall? People just don't do these exercises. Once they eventually use the return on investment calculations, it's as clear as can be that that is not a good deal. And that is one of the reasons why people eventually exit property, because they think it's not a good investment. But the fact of the matter is that they did not do their research. Another big issue is that people continuously buy property in their own name. Again, this forms part of your traditional way of owning property or owning the place that you live in, and you should buy it in your own name. That is some of the worst advice that you can give someone, and majority people that I consult with or speak with, I see that they own their properties in their own name. And although this is a mistake that a lot of people make, there's ways that you can get out of this, but majority of the time people will own 1 or 2 or even 3 properties in their own name, and then they are stuck. So you won't be able to build a significant property portfolio if you buy all of your properties in your own name. No matter how much money you make, eventually the banks won't want to lend you any more money. Another reason why majority people fail is because they pay full price for properties. And this forms part of buying a expensive and good looking property in a upscale market. They do not care what the real value of the property is because they are so emotionally connected to that deal that they will pay the full price of that property. This is the worst thing that you can do unless it is a very good deal and you don't want to lose the deal. But most of the times people pay full price for a property or above asking price, and that just means that they have no equity in the deal and no way that they can leverage that investment. Another reason is they buy their primary residence. Although there's nothing wrong owning a primary residence or living in your house that you own, but most people get stuck when they buy their first property. They will buy their dream home because that is where they want to live in. coin. At the end of the day, when the interest rates go up, like we are experiencing now, they do not have any affordability left. And that's where I get to my next point. They use up all of their affordability. If you do a pre-approval with the bank and the bank tells you you have affordability of 2 million rand to buy property, majority new property buyers will use up the total 2 million rand so that they can buy the perfect house. This is the worst mistake that you can make, because at the end of the day you are shooting yourself in the foot. Then another big issue is that they don't have an investment plan. Again, most people would look at a house as a good investment no matter what. They will not do their calculations. It's pretty, it's nice, it's in a good area, and they will just invest in that property without having any type of business or investment plan. I like to tell people that you should focus on buying your first property, then you should focus on your second property, then your third, until you can get to your 20th property. And that's having an investment plan. Most people will simply just buy the first property that they like, and they don't have a plan on how to get to their second, third, or 10th property. One of the biggest issues that I've also seen is people do not have an exit strategy when it comes to property. One of the first things that I learned when I started investing in property is the importance of having an exit strategy. An exit strategy can be multiple types of strategies, meaning you can resell the property for a profit. If you bought it for less than it's worth, you can refinance it and use your leverage to cover your shortfalls if it is applicable. You can rent it out to a different type of person, or at the end of the day, you can live in that property to make sure that you don't default on the debt. Having an exit strategy can be a very smart way to protect yourself from unnecessary risk, whether it's buying it for much cheaper or eventually renting it out to a different demographic. These are some of the biggest issues that I've picked up working with many different people starting out in investments, and all of them form part of lack of knowledge. And that is why I am making this video. Having the right knowledge is the biggest advantage that you can have, whether you have no money or a shitload of money. Having the skills to invest in property and to continuously learn is something that not a lot of people have. And what I wanted to touch on is to make sure that you continuously learn. Watch videos similar like this, read every book that you can, speak to people that you know are doing well in property, and make sure that you gain the right knowledge before you just jump into property investing. If you are just starting out and you have a lot of questions, I have just the course for you. And I know this sounds like a sales pitch, but at the end of the day, if you are someone that wants to learn as much as possible for a very small amount in a very short period of time, my property course can really help you out. I'll share the link down in the description, so check out the property course that I recently launched. I've received very good feedback from beginners and people that are more advanced. And at the end of the day, this is the best way that you can learn, especially if you want to focus on the South African market. If you have any questions about the course, feel free to pop me an email. I'll leave that in the description as well. And if you have any comments about this video, or if you want to add something, feel free to let me know down below.